All right, so last time we had talked about this chart here, which is sort of an overview of the various different business organization structures that we have available to us. And we talked about limited liability issues and tax issues, including when you have what's called a pass-through entity. Now, if you missed last week, I have a video on this lecture, which is on our Canvas page over there. And so the lecture is video, corporate LLC liability, and pass-through. So if you missed last week, if you watch those two videos, it's pretty much the same stuff we went over last week. Those are actually from a different class of mine. But we did a little background last week on just some of these different business organization structures. So if you watch those, you'll be pretty much caught up. And then we can chat about some of the great stuff and how the class is structured after class tonight. And I'll get you all caught up. You're fine. So what I want to do tonight is I want to go through and I want to focus on limited partnership, limited liability partnership, S&C corporations, and LLCs. And I want to talk about some of the nuances and how they're different in terms of structures, with the idea of if you're starting a business, what type of organization would be best for you to choose from. And I'll just kind of cut to the chase in a little bit. In the real world, in small business, most of the time what I'm seeing now, I'm a practicing attorney, and what I see in my practice is people are using S-Corps and LLCs primarily for small business. There are times when you want to use a C-Corp. We'll talk a little bit about that later on. But I want to focus on these 5 structures. Silent partner and general partnerships are still used, but they're kind of falling out of favor primarily because you don't have any liability protection in a sole proprietor or general partner. That's what we talked about last week. So if you watch those videos, you'll be caught up. All right, so let's talk about a silent or a limited partnership. So a limited partnership, and I have up here written the word silent partnership. And for you, on your handout, go to this handout here, limited partnership structure. That's what we're going to be going to in just a minute. But just before I get to that handout, so the idea of a limited partnership as a business organization is a very old idea. Limited partnerships have been around literally since ancient Greece, Byzantine Empire, ancient Rome. I mean, they've been around for a long, long time. And we see limited partnerships throughout the world. Almost every country has some form of a limited partnership type of arrangement within their structure. So they're pretty common historically. The idea of a limited partnership, and I've written here silent, a silent partnership, but you may have heard that term before. The idea, there's a handout right there, a handout packet. So the idea of a limited partnership is essentially was to put together a structure that would allow for investors to be able to input money into a business enterprise of some type. And again, limited partnerships go back, really they started with maritime law, law of the sea, with ships, sailing ships. And the idea was essentially you would have a form of structure. This isn't in that packet. We're going to be going to this page here. So basically the idea was to create a form of a business structure, in maritime law that would allow for a ship owner to go out and try to find investors to invest basically in a voyage. And the idea was the investors would put money in, they would buy a ship perhaps, hire a captain, hire a crew, go out and buy cargo from whatever port they're in, and then sail to wherever and sell the cargo, and then split the proceeds among the owner of the ship and the investors, and of course the captain and the crew. And the purpose of a limited partnership, as opposed to a general partnership, was this idea that limited partners want to be investors, but they don't really want to be involved in the day-to-day business operations, sailing of the ship, and all that kind of thing. And so the idea was to create this partnership that would protect the investors that are putting money into the structure from liability. above and beyond what their investment is. Now, if they put an investment in as an investor, the investment, of course, is at risk. The ship may sink, they may lose the cargo, and then they lose the money they put into the investment. But the idea of a limited partnership was to give the limited partners a level of protection that they would not have any exposure beyond their investment. That is, if there was a lawsuit or other type of credit or other claim against the business, that the limited partners may lose their investment, but that was the extent of their potential loss, their liability. So they wouldn't lose, nowadays, their house and their car and their retirement and all their personal assets. So the basic way a limited partnership is structured, and I'm going to use kind of a different example than a ship. I'm going to use an apartment building. Now this could also be, so this is our apartment building. And so essentially the idea is, this is pretty common in real estate type of activities, where they're going to be a real estate investment, so in this case an apartment building, and let's just say the apartment building is going to cost $3 million. So the idea is, the limited partners are each going to put in $1 million as an investment into the partnership. So they put that investment in to buy this building for $3 million. And in exchange, they're going to get a 30%. Is that showing up okay? Yeah. And in exchange, they're going to get a 30% share. Now I know that doesn't add up to 100. I'll get to that in just a moment. And so the idea is they put money in to buy this apartment building, so they're now a 1/3 owner, basically, well, not a 1/3, a 30% owner of the partnership which owns the building. And the idea is twofold. They want to get a perhaps monthly or quarterly return from the rent income from the business. And basically they're just going to get a check, every month, let's say. And then if the building is eventually sold in the future, hopefully it appreciates, maybe it's going to go to 5 million or 6 or 10 million, something. Then they're going to also get a 30% return on the growth, which is called a capital gain. And we'll be talking about that term capital gain off and on throughout the term. But they're going to get a 30% participation in that growth. So their risk, of course, is $1 million. They put $1 million in, and if for some reason they get sued or whatever, they could lose that, along with any growth of the building. So the limited partners, should have made this a little bit bigger. So they are going to be investors. They are not going to have management authority. In fact, the traditional structure of a limited partnership was such that limited partners had to be silent. That's where you get that phrase silent partner or silent investor. Sometimes you hear that in the news or whatever. That's where that comes from. This is the idea that the investors are putting money into a limited partnership and their role is only that of an investor. They don't have any management authority whatsoever, or if they do, it's very limited to the point of only being able to make decisions about who is going to be the manager of the property. So we have 3 limited partners with 30% each, and the way that a limited partnership is structured, this is what we talked about last time, there will be a liability shield here and here, so that if there's a lawsuit against the partnership, maybe somebody's at the apartment building and there's a rotten staircase and it breaks and somebody falls as a result and gets seriously injured and we get sued for, $5 million or something. There's not enough money in the partnership to cover that $5 million. The building would be sold at a sheriff's auction for $3 million. There's still $2 million out there that needs to be paid. Well, if they try to go after the limited partners, so long as they have maintained their role as a silent partner, they have not engaged in management, there will be a shield that protects them from losing their personal assets. Now they're going to lose their investment. That's always at risk. but the idea is they will not have further liability. So if they can't afford to pay the whole lawsuit, there's insufficient money or insurance, then they're shielded from this liability. So that's kind of what I'm doing with my green highlighter here. That's our liability shield. So the limited partners, again, traditionally cannot have management authority. If they do, then they may lose their status as a limited partner. And then in that case, they would have personal liability, unlimited, including their personal assets. So now I say traditionally there has been some change in that, but that's still a basic idea of a limited partnership. The limited partners are going to be investors only. Now the other partner that you have is right here. This is the general partner. So the general partner we're going to hire as a manager. The general partner may or may not actually put any investment money in. In fact, it's really common where the general partner is like a property management company. You see this a lot in retirement facilities, shopping malls, big office buildings, student housing facilities. This is really common that are privately owned. You don't see that so much in Oregon, but in other states you see this type of arrangement for student housing, big giant apartments. And so the idea is that we're going to have a manager, and we're going to give the manager an apartment down here. That's where they're going to live. And they're going to manage the apartment building. They're going to be making the decisions about maintenance, when to replace the roof, what color to paint, what kind of furniture to get if it's furnished, who to hire and who to fire as a landscaper. They're going to collect the rent, do all the repairs, what a manager basically does. So in exchange for those management activities, we're going to give them a 10% share. They're not putting in any other investment, they're just managing. So that's where we get our 100%. 30% for each partner as an investor, 10% for the general partner. So the general partner has management authority, but along with that, the problem is the general partner also has potentially unlimited liability, meaning that the general partner, if the partnership gets sued as a result of an injury or a debt that cannot be paid or the mortgage or whatever the case may be, the general partner, because they have management authority, also has unlimited liability. And the idea, the theory behind this whole structure of silent partnership, limited partners that are investors without management authority, is essentially there's a trade-off. And the trade-off is, if you're an investor, you will be shielded from potential liability, but in exchange for that shield, you're going to give up management. And the idea there is that if you don't have that responsibility, you should not also have the liability that flows along with that management authority. As opposed to a general partner, the general partner has management authority, but with that is the liability that comes out of the responsibility of making good management decisions. So basically you have two roles, and they're very distinct from each other. The management role and the investor role. The manager manages, collects the income and does everything. They get a percentage. In exchange for that, they have unlimited personal liability. The investors put money in. They have a shield. It shields their liability beyond their investment. So again, this is a very old structure. Now back to the days of sailing ships where this kind of all originated, the general partner is probably going to be the captain of the ship. And then the investors will be, they put their money in and they just wait for the ship to come back and get their payout. Nowadays, again, we see this a lot in real estate. We see this a lot also in natural resource type business activities, which may be forestry or farming or mining, oil and gas. This is really common. We see, like for example, there's a lot of limited partnerships you can buy that are involved in oil and gas production and other types of mining activity, lithium and cobalt and whatnot. And so, and some of these are publicly traded. You can buy them on E-Trade or Charles Schwab or any type of a brokerage online. And the idea is that you put your money in, and then you're going to get money back from the lease of the property for oil and oil sales or whatever, mining, whatever the natural resource, forestry, whatever it might be. And again, you also see that a lot with hotels and other large commercial projects that may be publicly traded. So you can buy shares in, actually I've done this myself, I bought into a retirement facility in southern Oregon coast down in Bandon. And basically I put some money in, I did this in my retirement account, got my limited partnership share, and I just get a monthly check, which goes back to my retirement. So I don't have to do anything, right? That's the basic idea. So it's still a common form of ownership, and one of the, just sort of more to this kind of the second level, this general partner has unlimited liability. But there's a twist. And that is the idea that what if the general partner is a corporation? So now they have a way to escape total unlimited liability by incorporating. And so this, again, in the real world, when we talk about real estate or oil and gas or whatever, that's commonly how you see this structured, where the general partner will be either a corporation of some type or nowadays an LLC. You still have a limited partnership structure, but now the general partner can get at least partial protection by also incorporating or setting up as an LLC. So but traditionally you have those two distinct roles. Now there's a problem with that, especially in a smaller type operation where you have 3 people as investors and 1 as the manager. The problem is you're an investor, say this apartment building, you're putting $1 million in. Typically, if you're putting that kind of money into a business situation, you want to have some control over what's going on. You want to be able to vote. If you're going to refinance the loan, you want to vote on that. If you want to sell the property, you probably want to vote on that. If you want to put a new roof on, that may cost $500,000. You might want to vote on that. So that's one of the downsides to a limited partnership form, in that the investors really do want to have control, but they can't, or they lose their protection. And so in a situation like that, the way that would occur, just so you're aware, is let's say again there was a lawsuit against this partnership for $6 million. There's insufficient money to cover from the assets of the business, so now they're going to be looking to go after the limited partners. Well, if they can prove that the limited partners were actually kind of under the table, there's a handout right there. Yeah. If they can prove that the limited partners were actually in the real world engaged in management, then a judge can declare them to be a general partner and they lose their liability shield. And the way that would be done is through what's called discovery. In a lawsuit, you have the ability to get documents and that kind of thing, including emails and QuickBook files. And so, I might, if I'm the lawyer that sued the company, I'm going to subpoena all the partners and I'm going to ask for all their emails that go back to the general partner. And if I start seeing, like in their emails, hey, we want to refinance, or these terms aren't acceptable for the loan, or we want to hire this person to do our maintenance, that could be used against them to prove that they were actually engaged in management. And so, they may think, oh yeah, we're just going to do this under the table or keep it quiet, but there are ways to find that out, and if that occurs, they may put themselves at risk. So that's one of the big problems with a limited partnership kind of format. Now, eventually we'll talk about limited liability companies here in a little bit, and that solves some of those problems. But just the traditional structure, when we talk about a limited partnership, you have the role of the limited partner as investors. They have to maintain their silence. They cannot engage in management authority. They get their return on their investment, and if that's all they're looking for, that works out great. Now, there's another reason why limited partnerships are still fairly common, and that is they can be publicly traded, as I talked about earlier. If you've ever heard of what's called a REIT, R-E-I-T, it stands for Real Estate Investment Trust. Those are publicly traded investments that you can buy into either in a retirement account or outside of your retirement account. And they invest in everything from shopping malls to planned developments like in big giant subdivisions in Florida or Texas or whatever. And you can buy into those as a limited partner. The other way that we see a lot of these from an international standpoint, if you're cross-border, other countries, as I said before, do have limited partnership type structures, and they're recognized in other countries where LLCs may not be. So from a tax standpoint, we talked about this last week as a pass-through, and again, I do have a video on that, which we'll go over later. But essentially from a tax standpoint, the way it works is the partnership has to file what's called a partnership tax return. It's called a Form 1065. So that's a partnership tax return. Oh, by the way, I don't test you on my lectures. This class is kind of like in between undergrad and MBA in terms of detail. So you're probably going, oh my God, what's a 1065 form and all this stuff, right? Don't worry about it. My whole theory of this class as a seminar is really I'm going to get up and teach about what I, as a practicing lawyer, been practicing for 30 years, some of the things I see in my practice and real world stuff. So if you're kind of getting freaked out during my lecture that I'm going over stuff that's up here, no worries. I just, you get out in the business world, maybe someday something will come up in your life, you're like, oh yeah, I remember what that is now. And that's kind of my theory of this class. So back to a partnership here, the tax return would be filed, and then each partner would report their individual share on their personal tax return. So each limited partner is going to report the income that they received on their individual tax return, and then the general partner, of course, would report their 10% on their return. The partnership itself won't pay tax. It's a pass-through. So to file a limited partnership, and this is true with all of our entities we're going to talk about tonight, you have to file with the Secretary of State a partnership. It's called a certificate of partnership, and that shows that you are a limited partner under the laws of that state, and that again, that's done through the Secretary of State's office. In this class, I don't go through how that's technically done. We have another class on that here at Western, but just so you're aware. And you might also file what's called an assumed business name, which we'll talk about later. And then you're going to want to have what's called a partnership agreement. The partnership agreement is a contract between the limited partners and the general partner that lays out the details of how the partnership will be organized, when profit distributions will be made either on a monthly or quarterly or annual basis, whether or not there'll be any holdbacks of money to fund maintenance, how much you're going to pay the general partner, whether or not and under what circumstances you can fire or terminate the services of the general partner, those kind of things. When meetings are going to be held, what kind of notice you have to provide, and that sort of thing. So, limited partnership, really what I want you to know is that those two very distinct roles, that of an investor and that of a manager, who may or may not be an investor. Real world again, there are companies that act as property management companies that may be a manager for a whole number of different limited partnerships, and they manage, like there's one company I'm thinking of, they have rental houses, about, 3,000 rental houses, mostly in the Midwest, and essentially you can buy into the partnership. They go out and they buy rundown, mostly single family residential, then they fix them up, and then they rent them out. And you buy in, you get a share of the partnership, and then they rent them out to people. You don't have to do anything, you just get your check. So it works out pretty good. The other way that you see this in the real world, and again, this is more MBA level, but it's called a 1031 exchange, which we'll talk about when we get to real estate in a little bit more detail. But a 1031 exchange is when you sell, let's say I have a rental house, and I sell it, and it's appreciated in value. So let's say I paid like $200,000 for it, and now it's worth $400,000 because the market's really good. So I sell it, I now have $200,000 of profit. That's called a capital gain. That's subject to tax, which between Oregon and federal tax is about 33%, about 1/3, or even up higher depending on your income level. So I don't really want to have to pay that tax because I want to turn around and take that money and buy another house. It's like flipping a house, like you see on TV, house flippers. So I'm going to sell this house, and I want to take that money and put it into a new house, or maybe two. And then eventually I'll sell those and roll them over on down the line. And you can defer that tax so you don't pay it. Well, eventually, you might not want to be in the business of being a landlord. I see this a lot with people as they want to get older and retire. So instead of that, I can exchange the money into one of these type of structures and still defer the taxes, but get a monthly income. And we'll talk more about that when we get to real estate in a couple weeks. But pretty common type scenario for those type of activities. All right, so that's what we have with a limited partnership. On my chart here, again, for those of you that took my business law class 1, this is what we use there. Yeah, question?
So for the limited partnership, if there is any renovations needed, or furnishing or landscaping, whose pocket does that come out?
Okay, so generally the way this would work is you're going to get your monthly rent from this. Typically that money will go into a checking account in the name of the partnership. The general partner will have the ability to write checks off of that account. And that account will be used to pay for property taxes, utilities, other expenses of the property, insurance, that kind of thing. Usually they'll determine an amount to hold back as an allocation for maintenance, and then that would all be paid from the partnership checking account. And then at the end, and that's why payments are usually not on a monthly basis, or usually on a quarterly, because that way you have some time to figure out what your expenses were, and you're usually a quarter or a month behind on the payment. There's a lag. And so yeah, that's part of the role of the general partner, is to do all that. And then do the accounting, keep the books, send out a partnership statement saying this was our income, these were the expenses for the quarter, we're going to hold back X amount of dollars for future expenses, and then we're going to cut a monthly check or quarterly check with that net. And that partnership agreement is where that's all going to be defined. And some of those partnership agreements are like 200 pages long. I mean, they're big, thick things. And that's why it's really important to have that all detailed, so if there is a dispute, everybody has access to those records. You can go back and make sure that the manager is paying the bills and doing it properly. And that's going to be true with all these entities. You're going to have a checking account and perhaps a savings account in the name of the partnership to do that exact thing. Yeah. And then also to build up a little bit of a cash reserve in case you have a bad month or two, or a recession or something like that. So you're forecasting your future expenses. Well, on that point too, that money that's held back, we talked about this a little bit last time, it's called a retained earning. That is still going to be taxable to everybody, even though they didn't get the cash. Because it's a pass-through entity, so in theory they could have got the cash. That's another downside to this form of business structure, is you can hold money back, that's fine, but on paper it's still as if it was distributed, and you're still going to have to pay tax on it. So But again, still a pretty common form of business structure. If it's going to be, on a scale that I'm talking about, where you're publicly traded, you're going to have a lot more disclosures that you have to do, and pro forma filings and SEC filings and all of that. So, all right, so let's move on to the next type of structure. Oh, I forgot, here on this page. So, for a limited partnership, you have unlimited liability for the manager, that's the general partner, and limited liability for the limited partner or the investors. And then again, that single tax, that is the pass-through where the profits flow out based on their percentages. And then the general partner manages, the limited partners cannot manage. I should say cannot, will not. Cannot, not may, will not. Okay, so let's move on to the next structure, which is called a limited liability partnership, which is similar to a limited partnership, but it's also very different. So LLP. All right, so limited partnership structure, LLP. So limited liability partnership is a newer form of a limited partnership. It's not nearly as old historically as limited partnerships. And it was primarily created for professionals that provide services. So doctors, dentists, lawyers, accountants, architects, engineers, insurance agents, stock brokers, other type of service providers on a professional level. And the sort of the theory behind it is to allow for those professionals to have a common office, engage like a medical clinic, so they can split the overhead costs and all of that, whereas if you're just by yourself, it may not be economically feasible to do that. But to allow a level of liability protection so that a person would not be liable for the malpractice of your other professionals. So I'm going to structure this, instead of an apartment building, let's say we're going to have a medical clinic. So here's our medical clinic. That's a Red Cross, okay? That's our medical clinic. So same idea. Let's say this medical clinic is going to cost $4 million to buy the building, put the equipment in there, x-ray machines and all the stuff you need in a medical clinic, to hire employees, to get all the inventory and medicines that you need for a medical clinic and all of that. So we're going to have 4 different doctors. So doctor number 1, doctor number 2, doctor number 3, and doctor number 4. So they're all going to go in together to start this medical clinic. So as a doctor, they're concerned about, of course, the clinic itself, making sure that they pay the bills and all of that. But their primary concern in terms from a liability standpoint is if one of the doctors during surgery messes up and somebody dies during surgery, or they have permanent impairment, huge lawsuit for medical malpractice, or if a doctor misprescribes a drug or something or doesn't diagnose cancer, basically malpractice. Or it could be an engineer, maybe they're a civil engineer and their plans for a bridge are bad and the bridge collapses and people are hurt, and you have a huge lawsuit arising out of that, those kind of things. So the doctors want to operate this clinic together. They want to have management decision-making over the operations of the clinic itself. That is, mortgage, or if they're going to lease the building, entering into a lease agreement, when to re-roof, all the things that you do when you're managing a clinic, who to hire as a manager, which employees to hire, which ones to fire. So in a limited liability partnership, the basic idea is each partner is going to have 2 different roles, two different functions. The first function is that of a general partner. And so they will each be considered a 25% partner in this partnership. And for purposes of the clinic itself, they will have management authority. They'll each be entitled to vote, and majority wins, and that way they can have management authority. As a general partner with that, the problem is they have unlimited liability. Unlimited liability, which means if somebody comes to the clinic and falls down and breaks their head open and you get sued, they have potentially unlimited liability for the full amount of the lawsuit. Just like you would in a general partnership. They have management authority over the clinic, but they also have legal responsibility and liability that flows from having that management authority. So one role will be that of a general partner. Now, as a general partner, they will also be entitled to the profits that arrive from the clinic. So if they have a gross profit on the clinic, they'll file a tax return, and then they'd get a 25% cut of whatever the net profit was from the operations of the clinic itself. And also for the building, if they sell the building, then they would get a 25% share of any growth in value when they sell the building, the capital gain, the profit from the sale. So that's one side. Now, having unlimited liability is not a good thing because you don't know the extent of your exposure to risk. But on the other hand, for the most part, you can manage that risk. Somebody coming into a clinic, and we're not talking about doctor professional malpractice. We're talking about somebody comes into the clinic for an appointment and they fall down and get hurt, or we get sued because the bill didn't get paid. Those kind of things. We're not talking about misdiagnosis. We're talking about everyday operations. Or maybe we have an employee that files an employment claim for maybe they weren't paid overtime and they should have been. Those kind of things. That risk is manageable, and typically it's not going to be the huge dollar amounts that you might see for a malpractice type of a claim. That can be managed through basically voting, make sure things are being done properly, and of course through insurance, having adequate insurance that will cover the building in the event of an injury or a fire or whatever, have insurance that will cover employee liability issues, those kind of things. So you can manage that risk is what I'm getting at. Now the scary part, of course, is malpractice. So for purposes of malpractice, the idea will be the doctors each will have their own liability for their own individual malpractice. And each doctor, assuming they were not involved in the malpractice itself, so assuming the doctor was not involved in the treatment or the diagnosis or the surgery or whatever led to the malpractice claim, they will have insulation from liability that arises out of the other doctors that were involved. Or if it's just one doctor that messed up, the other three doctors would be protected from that doctor's individual malpractice. So you have this dual role, that's what I mean. From a general standpoint, they all have liability for the clinic, the debt of the clinic, etc. From a professional malpractice standpoint, their liability is compartmentalized. Each doctor is responsible and liable for their own actions, and if they get sued, the doctor that caused the harm may be personally liable for their own professional malpractice, but the other doctors are insulated. And again, the whole idea with this was to create this form of structure that will allow the doctors to have management authority for the joint operations of the clinic, but not have potential unlimited liability exposure for malpractice. Or again, it could be an engineer or an architect or a dentist or whatever, right? Lawyers. So this is a pretty common structure. You still see this quite often. This may be, I've got 4 partners here. Maybe we have a law firm that has 400 lawyers. We have offices throughout the United States, a huge law firm. So in that case, well, the general partners would be like a management committee. So maybe we have 400 lawyers that are all partners, but we have a group of maybe 5 or 7 that are on the management committee. And so they're the managing partners, and the other lawyers are going to be maybe junior partners or some non-management partners. And then they have that liability shield. So that can be structured in multiple different ways, kind of beyond the scope of what I want to get into. But that's sort of the idea here of a limited partnership. Now, when we talk about here, 25% share each, they're all equal for the operations of the clinic. But there's a second component to income. The income from the clinic may be derived from selling drugs to for prescription drugs, or if you break your leg, you get a cast and you rent the wheelchair and all that kind of stuff, right? But the other income is going to come from the actual medical practice itself. So the doctor goes and does a surgery, of course they're going to charge for the surgery, and that gets charged through the clinic to the insurance company. And usually the way that'll work is the doctors will be paid based upon their gross receipts, their gross production. So let's say this doctor bills out $2 million a year, this doctor bills out $5 million a year, this doctor bills out $1 million, and this doctor bills out, I don't know, $10 million. So obviously this doctor's doing the most work, so they're generating the most income. Yeah, that wouldn't be fair to have their money that they make here split equally. So typically you'll have sort of 2 structures on how that income is paid out. And essentially it'll be pro rata. So if we have here, 18 million total, then it's going to be based upon that percentage. So this doctor is going to make more than this doctor that only billed 1 million. And then they'll figure out through a formula how that's going to be paid out. You see that a lot in medical and dental and in law firms where you're billed based upon a percentage of what you actually generate as gross income. Now typically that's done, you don't get the payment until the money's actually received back from the insurance company. You may bill 10 million, but you may not be paid for 6 months. So you don't get paid on that until the money actually comes in. That's really common, lawyers, doctors, dentists, that kind of thing. So that will all be detailed in that partnership agreement. Again, that's a contract among the partners that will put together these 2 different percentage plans on how they're going to be paid for their billings on their medical practice side and how they're going to split the income from the clinic side. And that'll usually be based on a more equal type percentage. Again, you have to file with the state and then might use an assumed business name, which we'll talk about later. So the difference between limited partnership and limited liability partnership, you have these 2 different structures. Limited partnership, the investors and the manager. Limited liability partner, both management authority and also basically not really an investor, but professional side liability, but also professional income based upon how much you produce. Or it could be real estate. Maybe these are real estate agents. And some of them are selling more properties, they're getting a bigger commission than the other ones. So it's all done on a pro rata basis. All right. So back to my chart here. So we have these 3 different forms of partnership. Again, a general partnership is the most basic. In a general partnership, all the partners have unlimited liability. You have no liability shield whatsoever, so it's really not the best format. In a silent partnership or limited partnership, you have those two different roles we talked about. And then in a limited liability partnership, you have general partnership with management authority, but also liability, but you have limited liability for the actions of the individual partner. So unlimited for general obligations and limited for the partner's activities. All right, now here's something I want to point out to you about a partnership. Every form of partnership has at least some component of unlimited liability. Unlimited, unlimited, unlimited. In other words, there is no type of partnership that will allow for complete liability protection if you have management authority, complete liability protection for the actions of the other partners. None of them have full limited liability. And so that is one of the downsides to a partnership form of business structure, is at some level there is always going to be unlimited liability if you have management authority. Now, let me tell you why that is. The theory of a partnership is different than the theory of a corporation, which we'll get to in a moment. A partnership is considered to be a joint activity among all of the owners, the partners, that they are collectively working together with a common purpose to operate a clinic or an apartment building or whatever the case may be. A partnership is not considered to be what's called a separate entity. It is not an entity of its own, it's a collective of all of the partners themselves. So the partnership itself is the sum of all the partners working together. It's not a separate thing. Corporation is different. Corporation is what's called, let's go ahead and talk about corporations now. Okay, and I apologize for my bad handwriting. I inherited that from my dad. Our handwriting is almost identical. So, kind of a joke here. What profession is known to have the worst penmanship, handwriting? Yeah, my dad was a doctor, so. Yeah, he was a surgeon in Vietnam. Can you imagine that? Never would talk about it. I tried to get him, well, I can't even imagine. MASH doctor. So, corporations, all right? So there are two types of corporations, a C Corp and an S Corp. We'll come back to that. For now, I want to just talk about the basic theory of a corporation and how we get to this idea of limited liability. It starts with this term right here, juridical entity. Juridical entity. So, juridical means at law, or in the eyes of the law, as opposed to reality, right? It's called de jure versus de facto. So juridical means in a legal manner or under law, it is an entity. So when I say entity, that means something that exists. There are different kinds of entities. We are human entities. We are human beings. Now, for purposes of the law, we as humans each are considered a separate legal entity, apart and distinct from everybody else. Now, what do I mean by that? What I mean by that is, as a human, we are and have the ability to have and own real estate and other type of assets in our name. We have the ability to collect wages and income in our name. If we do something wrong, we can be sued, and we have responsibility for our actions as an entity. As separate entities, we do not have liability for other people unless we agree to it. So I don't owe money on your credit card unless I co-sign on it as a guarantor. So humans are each considered an individual legal entity. Now, in the legal world, we have other type of entities that basically are fictitious. They're not real. What do I mean by that? Corporation. Corporation is an entity under the eyes of the law, not quite the same as a human, but it is considered a legal person. You may have heard that term before, corporate personhood. You see it in the news sometimes. Well, what does that mean? That means a corporation, and what is a corporation? I mean, a corporation technically is just a piece of paper. And literally, articles of incorporation, that's the document that you file right here. Whoops, articles of incorporation. If I'm going to start a corporation, I file that paper with the Secretary of State's office. And I have now created a legal entity as a corporate entity. That's where corporation comes from. Corporate, a body, corporeal, a body. And so a corporation is essentially a legal person, which is separate and distinct from the owners of the corporation. So a corporation has its own rights. A corporation actually has First Amendment rights, not to the same degree as a human being, but as limited. Corporation can own assets in its name, can raise money on the stock market if it's publicly traded in the corporate name. The assets of the corporation are owned by the corporation, not by the shareholders, the owners of the corporation. The corporation has legal liability, meaning that if the corporation does something wrong, it can be sued in the corporate name, not in the owners, but the corporate is activity. A corporation can actually be convicted of a crime. That sounds kind of weird. How do you convict a piece of paper of a crime? What are you going to do, put it in jail? No, you issue a fine or revoke a license or something. That does happen sometimes. Usually you'll see that in like an environmental spill or something like that where a corporation has spilled or intentionally dumped something. But the idea of this corporate juridical entity is that the law creates this theoretical entity that doesn't exist in the physical world, but it does in the legal world. Kind of like the metaverse or something. I don't know. It's not real. It's like an avatar. Or, not quite sure how to explain it other than that. So we have other types of juridical entities other than corporations. A government is a form of a juridical entity. It is a governmental entity. A city is a municipality. It is an entity in and of itself. A university is a form of an entity. It's a governmental entity. Nonprofits, so Red Cross or the Rotary Club or whatever, those are nonprofit entities. Some are tax exempt, some are not, but they are a form of a nonprofit corporation, so they are also a separate entity. We have international entities like the United Nations, which is called an intergovernmental organization, which is a form of an international entity that has its own existence. So you get the idea. Unions, religious organizations, other type of entities that are separate from the people that are actually involved. So this idea of a juridical entity basically is the idea that the paper person, not a real existing person, but a paper fictitious person, has separate life, in a way of speaking, from the people that own it, or the other entities that may own it. Now, the reason why I'm talking about that is this fundamental idea, and there's a fundamental difference between the idea of a corporate or other form of entity and a partnership. Again, a partnership is considered the sum of the partners. It, in itself, is not a separate entity. Corporation is a separate entity. Now, how does that create limited liability? We talk about limited liability. Full limited liability for debt, for lawsuits, for other types of claims against the corporation. And the reason why this creates a limited liability situation is, let's say it's a debt, $100 million to go out and purchase an office building. And they get a loan, they can't pay it. Because it's a separate entity, the debt is in the name of the corporation, not the owners. So the corporation actually owes that money. If the corporation cannot pay it and has no assets, basically whoever lended them money, they're stuck. Unless they have personal guarantees, which we talked about last time. So a corporation, even a one-person S corporation, is a separate legal entity from the one person that owns it. I'm a practicing lawyer. I'm an S corporation in my law practice. My wife's a dentist, S corporation. She's the only owner. So the idea is you have a corporation, and you may be the only owner, but the corporation is what owes that debt, not the individual owner. Now, real world, we talked about this last time, that's where the bank would require me to personally guarantee the corporate debt, so they could also go after me. So it seems kind of weird that I could be the only owner of a corporation, but the debt is in the name of this piece of paper, not me. You know, it seems really bizarre. But that's the legal theory of how we get this limited liability through a corporation. And that is, just like I don't know your Visa bill unless I sign on to it, you're a different entity than I am. Same thing. Paper corporation is an entity, and then I'm a human entity, I just happen to own it. So it's a legal fiction, is what we call that. Fiction meaning it's not real in a way, but obviously it is real. You know, Google and Microsoft and all corporations we're all familiar with. Those are real things in one sense. In another sense, they're totally made up. Another way of looking at it. Now, why am I spending time on that? Because it's a fundamental, you have to have that fundamental understanding. So like I own shares of Apple stock, right? Does that mean I can go down to Cupertino and just pound on the door, hey, I want in the headquarters? You know, no, they're going to throw me out. You know, yes, I may be a part owner, not minuscule, I don't have very many shares. But that doesn't mean I have the right to manage or do anything else in the corporation, because it's a separate entity. So that's where we get this fundamental idea of limited liability. That a corporation, because it's a separate entity, the debt and liabilities for lawsuits and debt and other claims are that of the corporation and not the people that are the owners. All right, so let's talk about a structure of a corporation. And this is true for both a C Corp and an S Corp. There are variations of this, but just the basic structure, just to give you an idea. Okay, so we have the corporation itself, which again is a separate legal entity. The corporation is owned by shareholders. So the shareholders are the owners. Now, this is where a C Corp and an S Corp may be different from each other, but I'm going to keep it simple now, and we'll get into that more in a minute. So the shareholders basically invest money or other assets, and in exchange for their investment, they are given shares of stock. And you know this is basic, but okay. So you put an investment in the corporation, which may be money, but it could be other things. So perhaps I own land, and I exchange maybe it's a farm, a farm ground, and we're going to have a farming corporation. So I transfer my farm in exchange for shares of stock in the corporation. Or it could be I have a logo or a design that's subject to a patent for an invention, or I have trademark or copyrights. Perhaps I wrote a song that's wildly popular and now gets royalties, and so I have a copyright on that song or that book or artwork or non-fungible token, right? NFTs. or other type of asset, I could transfer that to the corporation and get shares of stock back, based upon whatever value we come up with. So it's not just money, or it could be expertise. I know how to build, or I'm an inventor, I have expertise that I exchange for stock, or I could receive shares of stock in exchange for my work, like stock options and other stock as payment for wages, especially in a startup. You see that a lot. So essentially what I'm getting at is there's an exchange. I give money or some other asset or work, and in exchange I get shares of stock. Now percentages, ownership percentages will be based upon the number of shares of stock that are held. And again, most of you know this intuitively, but there are some nuances here. So let's say in this case, each shareholder has 30 shares of stock, which means there are 90 total shares outstanding. So each of them would basically be a 1/3 owner, right? Based on the number of shares. The number of shares outstanding is the total number that have been issued. Now while I'm on that point, so I don't forget, when you're setting up a corporation, that piece of paper I'm talking about, I'll show you what it looks like. Looks like this. This is actually the form that you would file to start a corporation. You see right here, paragraph 5. This is from the Oregon Secretary of State. So when I start a corporation, I have to fill this form out. And one of the things I have to do is I have to tell the Secretary of State how many shares does the corporation authorize that could be issued, could be sold or otherwise issued out to the public. And this is something you can come up with arbitrarily. If you're going to be publicly traded, if you're Apple or Google or whatever, the Alphabet Corporation, you're going to want maybe 1 trillion shares. There's some huge number of shares of stock that could be issued. Doesn't mean they will be issued. They could be. Those are called treasury shares. They're held by the corporation. They could be issued at the startup or at any time in the life of the corporation going into the future. There's a reason I'm telling you about this, because one of the documents we're going to talk about is what's called a non-dilution agreement. So the number of shares, and this is something that if you're ever looking at an investment, you're going to want to know that. How many shares are authorized that could be issued by the corporation, especially in a publicly traded corporation, and more especially if it's what are called penny stocks, basically stocks that are traded for maybe 1 cent, 5 cents or something. Guys ever see Wolf of Wall Street, that movie? That's what that movie's all about, trading. It's called over-the-counter shares. Those are publicly traded companies that are not on the New York Stock Exchange or NASDAQ, and a lot of them are on the Canadian stock market, and they're sort of Wild West of corporate stock, kind of like crypto is now. Same thing with crypto. You want to know what the limited amount of crypto might be. Like Bitcoin's 21 million maximum that will ever be issued. Dogecoin, I think it's unlimited, or Shiba. I don't know, you guys do crypto? No?
A little bit.
You want to talk about crypto in class sometime?
We
One
can
of
talk
our
about
classes?
it.
Did you like that?
Yeah.
Yeah, okay, we'll do that maybe in a couple weeks. I do a little bit of crypto myself. I'm not an expert by any means, but anyway, long story short, the number of shares that could be issued, you want to know that, because if I own 100 shares of something, or well, let me go back to my example. If I own 30 shares and I have a 1/3 ownership interest because there's only 90 shares out there, but if the corporation could issue 1 million shares and they turn around and issue 100,000 shares to somebody else, I now went from 1/3 down to less than a percentage point. So the value of my investment just went to almost to zero overnight. Now that's what the Wolf of Wall Street movie is all about. And that was pretty That does happen. Same thing with crypto. You know, if there's a trillion potential out there and they flood the market with what are called treasury shares, all of a sudden it goes to nothing. So that's something you want to know about. We'll get more into that later. For right now, I just want you to know that your percentage ownership is based upon the number of shares that you have, and versus what are outstanding, okay? Now this is where it's different a little bit between an S Corp and a C Corp, because an S Corp can only issue one type of share. C Corps can issue different classifications of shares, and again, we'll talk about that later. So for right now, let's just keep going on this page. So we have 3 shareholders, and the shareholders each hold 30 shares of stock, so they're 1/3 owners each. Okay? Simple enough. Now the shareholders have very limited management authority. As a shareholder, the only real authority that you have, and this depends on the corporation, but for the most part, the only real management authority that shareholders have is to elect, that is vote, on who will be on the board of directors. And you vote the number of shares you own. So the board of directors is the top level of management of a corporation. Policy-making level of management. Typically the board of directors, in a big corporation or even a medium-sized company, they're not going to really be involved necessarily in the day-to-day stuff. They're going to be more policy, big picture decision-making, things like that. Now in a small company, of course, the board of directors are usually the same as the shareholders. You know, again, I'm an S Corp, so I'm my only shareholder, just me. I'm the only person on my board of directors, it's just me, right? So, you know, that's real, in small business, usually the board of directors will be the shareholders as well. But once you start getting a little bit bigger to where it's not, you know, not manageable, then the board of directors will be elected by the shareholders. Now obviously the more shares of stock you have, the more votes you have, usually, not always. And then you can vote who is going to be on the board of directors. Of course, you're probably going to vote for yourself, right? So, from there, the board of, and that, oh, by the way, that is done typically at what's called the annual meeting of the corporation. The annual meeting. A corporation by law has to have a meeting at least once a year. Typically they're held more often than that. For, you know, in a large publicly traded corporation, they may be monthly or bi-weekly or ongoing. And you also have a shareholders meeting on an annual basis. So you have to have a board of directors meeting and a shareholders meeting on an annual basis at least. And that's where the shareholders vote on who will be on the board for the upcoming year. It's also typically true of a nonprofit. So the board of directors then will appoint the officers of the corporation. They will vote on who will be the officers. So the officers of the corporation are the next layer of management authority. Now in Oregon, you have to have a president, a secretary, and a treasurer. Those are mandatory, or an equivalent to that office, which may be a chief executive officer in lieu of a president, treasurer, in lieu of that it may be chief financial officer. It just depends on how you want to structure your corporation. Sometimes you'll have dual levels of officers. So you might have at this level, which is a higher level officer, a CEO, a CFO, CLO, COO, chief executive officer, which is like the primary officer